I'm Osborne Foreman. My dad named this fake plant Keith, and in this video today I'm going to be showing you the UK stocks I bought, as well as talking about how my strategy in investing in the stock market has changed over the first year that I've been investing since April 2020. And if you like the video, please drop one of these to support the channel. According to Google Finance, in the last 4 days, the FTSE 100 is down 0.02%, the FTSE 250 is actually up 1.21%, and the S&P 500 is also up 1.14%. My portfolio has done very well this week and has actually managed to outperform the markets, climbing by 3.01%. However, you may have noticed that the number, or the total value at least, that would be at the bottom corner of the thumbnail is increasing at a faster rate than my performance. Please do not assume that this is performance, as some people have thought that. This is simply because I'm putting more cash in just before the tax year ends, as I want to make as much use out of the 2020 to 2021 ISA wrapper. And yes, I flap my hands around a lot, I'm channeling a spell. In the last few weeks, I've been transferring my position of Argo blockchain from my Trading 212 general investment account towards or inside of my Freetrade ISA wrapper. And yes, I've also been getting a lot of questions. I do use Freetrade through my stock and shares ISA, and I will continue to use Freetrade into the next tax year. And if you'd like to sign up to Freetrade and get a free share worth up to £200, then click the link in the description down below and sign up using my link. In which my Argo blockchain position on Trading 212 was entirely through free share referrals, and I'd invested this money over a few month period and gotten an average of 101 pence per share. This had meant I'd gotten roughly, and I don't know the exact percentage figure, around about a return of 128% when I sold the shares at around 235 to around 240 pence per share. This money I've taken out of that general investment account due to being suspended by Trading 212 and the threats that had been left. If you're interested in that, I'll leave a card at the top right of the video. But I didn't feel that my money was safe there anymore, and I really wanted to get that money outside of that taxable area and inside my tax wrapper, the ISA. And thus, that's why my total portfolio value is a lot more inflated. Although, since I did invest outside of my ISA, and I didn't really announce when I first bought Argo blockchain on Trading 212, at least in the portfolio updates, I've decided that I'm not going to calculate the original performance or the bag that I'd gotten from this. Instead, I'm just going to look at all the money that's inside the ISA and see how that does instead. When I first started stock picking in April 2020, I will admit that I didn't have a clue what I was doing. And now, fast forward one whole year with the experience behind my belt, I will admit I still do not have a clue what I'm doing. Seriously though, when I first started, I dived into dividend stocks. The appeal behind them was great for me, as it's almost instant gratification in that regard. I would buy a dividend stock, I would then see, oh, I got a yield on cost of perhaps 4.33%, and then I'd be like, well, for the rest of my life, I'm now getting 4.33% on the dividend, and that's quite exciting to think about in that reality, especially when you can visualize what you do with that. And I'm grateful to dividend stocks, as they allowed me to perhaps idolize my own future and what I see of the world. It taught me that I should be looking about what my goals are for the long term and then invest now to achieve them. And in my mind, I dreamed of being on a beach in Southeast Asia with perhaps a glass of rum in my hand and perhaps a little tablet where I could be looking at the stock market, whilst all of that would be completely funded by my investments, which would be dividend stocks. At that point, that would be financial independence, in which I would never have to work another day again. And thus, dividend stocks can really open that reality around, and is quite a great way to get started investing. Thus, back then I was looking for companies with higher dividend yields, which can actually be seen as a red flag, an indicator of perhaps a bad investment move. This is because the yield is high for a reason, and if it was a quality company, investors would be buying into this stock, which by buying into the stock, the share price would rise, and thus the dividend yield would decrease. Although it's also important to remember that when I started in the pandemic crash, which I believe to be the perfect storm for myself, as it taught me what companies to avoid and to immediately start looking for the higher quality ones that are profitable with strong balance sheets. Most stocks in this time period had dropped in value, leading to some very attractive high yield investments. However, I feel the fault I had with these investments is that I looked at these stocks as if they were high interest savings accounts. And in reality, I don't really think I should have. And whilst I don't think any of my original stock picks were bad in any way, such as Aviva, Shell, or even Red Row, I certainly believe I was chasing the dream of those high dividend yields with hopes that I could have them for the rest of my life. Since then, I've adapted my strategy at looking at companies with strong dividends that have great track records of dividend payments towards a more growth-focused portfolio. I do this primarily because of my age, and thus I'm able to have a higher capacity for risk. Quality dividend companies are usually mature, they're usually very profitable, and thus also very likely a lower volatility. Whilst this isn't bad by any means, I don't feel that I'm the target audience for this investment. This is because they are a mature company. Most of the growth potential is already in their history. They are likely market leaders. There isn't too much for them to gain, and thus their earnings, a majority of them, they pay out as dividends. Their profits are paid towards shareholders as dividends. Whereas I could look at another company that perhaps is a disruptor in a certain sector or industry, and thus this company could reinvest all of its money back into organic growth, and thus, or even inorganic growth, and thus perhaps generate faster or higher returns in my time period of investing. Since I also have a low amount of capital relative to where it could be, and yes, I am 21, I do have £24,000 invested, but that doesn't mean, and whilst that may be a lot to someone else, or you shouldn't compare yourself to others in that regard. I'm comparing it to where it could be, and I could certainly see it being a lot more. And so at the moment, I feel that this isn't much, when perhaps in 10, 20, 30 years, this could be a 7-digit portfolio. The idea is that currently, if I invested my entire portfolio into dividends, I might get £1,000 a year. And that does sound quite good, except that would only be around 4% performance per year, and I might be better investing in index funds, assuming that there is no capital growth, for example. Whereas if I'm investing in companies with lots of growth potential, in sectors with that long-term growth potential, then it might lead to better performance than that or even the index funds, which is my ultimate goal, to outperform the markets whilst also paying less fees. Since I'm planning to invest for the rest of my life, and that could be upwards or perhaps even 50 years, it might be shorter, I could be in quite a tragic. But the main thing is that I plan to reinvest or invest for the rest of my life. This means that if there is a big market crash, stocks drop by 70%, and we're in a terrible bear market that goes on for 3 years, I can likely outweigh this duration, even if it's like the Nikkei 225, which is Japan's index, or their better top companies by market capitalization. Even if the stocks trade sideways for 30 years, I could potentially have another 20 years to invest. It's even easier for me personally, as I have little to no regular expenses or bills. I don't have a mortgage, and I don't have people dependent on me like children. Therefore, at this stage in my life, I feel that I'm missing an opportunity if I choose to only invest in dividend stocks, whereas I could look towards rapidly but sustainably growing upon my capital by investing in a growth-focused portfolio. But when I say growth stocks, I don't mean highly speculative companies with no revenue, negative cash flow, and of course extremely unprofitable with only a story to drive returns. I mean companies that are profitable, that are in industries with long-term growth potential, that have competitive advantages over those in their industry, also have substantial moats, meaning it's difficult for other companies to take up market share away from them, and even high barriers to entry into the specific industry, meaning that it's difficult for new companies to come up and thus disrupt the industry. As such, I look for companies that grow their financials at faster rates than their competitors, as My returns are not going to be driven by a majority of price multiple expansions that you might get fortunate with value investing or finding that extremely speculative stock that generates a 10 times multi-bag. Instead, I hope that the driver of this performance is that financial growth, and thus that would be reflected fairly in the share price. This doesn't mean that I'm going to completely avoid myself of investing in dividend or value stocks, but rather it means I'm going to be focusing on these growth opportunities. I do think there is a balance to be found in moderation, and thus it would be advantageous to have a mixture of dividend, value, and growth. Thus, if you think about it, a dividend stock would be great in a period of a bear market or where the markets are trending downwards, at which point you may still be getting that dividend income that may be grown upon. That money you could then reinvest into these beaten up stocks due to the markets falling. Whereas at that point in time, growth stocks are going to look a lot more grim. The outlook isn't going to be positive, and thus perhaps sentiment would be much lower. And I still see value in holding these stocks. As for value companies, my only play at the moment is Ashtead Group. But since value stocks seem favourable at the moment, especially recovery plays for the reopening of the economy, I'm not going to be buying just yet, and instead I'm going to wait until perhaps they become out of favour once more. One other change to my investing strategy is the incorporation of swing trades. When I first started, I was very heavy on absolutely zero trades. And whilst at the moment trading may seem better than it might be in a realistic situation as we're in an early stage bull market, at least when talking about the US markets, and it might be easier to trade, I do want to try some swing trades in my portfolio. I'm only going to invest a small amount of capital on speculative companies that can give me some returns. Thus, I would hope to put this money in these stocks that I'm well researched in, perhaps make 20 to 30% on a swing trade, or hold that stock for a few months, see how it goes, or buy the rumor, sell the news, and then use that profits to sell and then reinvest into my longer term holds, with hopes that perhaps I'm able to find a way, instead of obviously working harder and making more money, but to also perhaps make more money already inside the ISA wrapper. I'm very likely going to be making a Q&A video on my portfolio, as I imagine there's lots of questions. So if you have anything you would like to ask about my portfolio, please leave a comment down below and it may be addressed in that video. Furthermore, I'm going to be talking about performance this week, in which I hope for this video to dedicate to the investment strategy and how it's changed over the last year, and then in the next video to talk primarily about the numbers, how well I've done, and if I truly am worth watching on YouTube. The top riser in the portfolio this week was Team 17, gaining 4.23%. This stock was impacted by the squeeze on valuations when growth stocks were being pulled down. This is because this stock greatly benefited from the pandemic, and thus investors perhaps don't believe that the growth will continue in the next few years. I think that's a fair view to state, although I'm going to go against the grain in this regard, and that's why I have been continuing to buy this stock, especially as it is still below my average price, as I bought near to the all-time highs. Although as the economy reopens, investors may believe that they're unlikely to benefit as much, as people will be spending their money elsewhere rather than their diverse catalogue of indie games. Although compared to their industry/competitors, the likes of Frontier Development and also Sumo Group, their price to multiple, their price to earnings and price to book looks much more favourable, and thus I'm happy to be invested, as I also believe Team 17 is of a higher quality. I bought an additional 16 shares of Team 17 this week, bringing my total position size to 203 shares. The other top riser in the portfolio was Ashtead Group, and this stock has continued its meteoric rally that just seems to not have a significant pullback. One could look at the graph in the last 6 to 12 months and you can see how fantastic it truly looks. In the last 6 months, this stock has climbed by over 55%. And without any significant pullback, especially climbing another 3.66% in the last 4 days, it does seem slightly concerning. Whilst I can see that investors may be more willing to pay a premium on the investment, I certainly would be if I viewed it as more of a growth stock, which it could be, I feel that there is some red flags in my head. My gut is telling me that this should be due a pullback. Logic in the market would state that. However, there isn't always logic in the market. However, despite my gut telling me that this may be due a significant pullback, I'm going to ignore it. I'm going to expect that perhaps it may drop significantly, and at that point I'm not going to try and time the market. I'm not going to sell my position prior to a dip. Instead, I'm just going to try and build up cash. I've now got a huge majority of my net worth invested in the markets, in which I only have a very small portion of money outside of it, and thus I could use this time to build up cash. If all of these stocks are climbing in value, cash could be a very powerful thing to have in the markets, and thus I will likely wait until Ashtead Group becomes once more favourable to buy, and if I don't, oh well, at least I've got 40 shares invested and I will continue to have returns on the investment. The top diver in the portfolio didn't actually lose value but didn't climb by too much, although for a week's return and considering the average yearly return of an index fund, I think it's pretty fine. Argo Blockchain only climbed by 1.64%, and this is because Bitcoin isn't really moving much, it's trending sideways. I don't do technical analysis, and so I'm not really too bothered about it. I'm not invested in Argo Blockchain primarily for Bitcoin anyway, nor am I invested for Zcash. Instead, I'm invested in Argo Blockchain for the whole purpose of buying the rumor and selling the news. The idea that I bought Argo Blockchain with the purpose of trading it as a swing trade, which I'd mentioned earlier in the video. The idea behind it is that I bought at an attractive valuation with hopes that when they get listed on the Nasdaq, that this would become a fairer valuation to their competitors, and thus we could see perhaps a 100% return. At which point I would consider taking profits. I may even cut half of my position so that I can leave the rest to free ride and invest that profits into my long-term holds or hold it as cash. I'm not so sure, but whatever it is, as I've said before, I'm not bullish on long-term Bitcoin, but I may keep an exposure there as I could very much be wrong. I transferred the remainder of my Trading 212 portfolio into my Freetrade ISA, meaning I now hold 1,819 shares of Argo Blockchain. I actually announced this live on my Patreon as I give live stock updates on that platform, and there's also an exclusive monthly stock to buy that is extra from the video I uploaded this week. And so if you're interested in that, click the link in the description down below and check out my Patreon. It's much appreciated, thank you. As for the rest of my holdings, they've all had relatively similar performance, ranging between 2.54% and 2.61%. Boohoo was the weakest of the trio, but it's nice to see that it is slowly but steadily climbing back up to its all-time highs. It's still quite a far way down, and if it does go up to its all-time highs, my portfolio is going to rally quite significantly. My camera overheated, so I'm going to try and keep it brief. I'm confident on the outlook of Boohoo as they are set to not only benefit since the pandemic, but also continue to benefit in the reopening of the economy. Clubs, pubs, festivals, they may all reopen in the next year. I think people are thus going to be buying clothes to impress their peer groups or others. I perhaps don't share this sentiment, but I believe a lot of people will be doing this, and it's always also a great sentiment boost to see someone unknowingly share some of the posts perhaps on social media, and I can just sit there continuing to be smug as I'm an investor, silently just watching these posts. My position size is still 2,500 shares of Boohoo. As for Halma, their rally had continued and they've climbed by 2.60% this week, although a very minor move in my portfolio now that they are the smallest position. I absolutely do not regret cutting 1/3 of my position, which was at a low as I moved my money into a stock that had fallen further at that point in time. Whilst in the short to medium term it may look like I've made a mistake in that regard, I did plan, I did think about it, and I did put some care and effort into whether I should sell Halma, and the ultimate decision was I was going to sell Halma and reinvest into Games Workshop as they are at a much lower valuation in comparison. And thus that is why I had sold 1/3 of that position, as I feel that there are more returns to come with Games Workshop. And even if Games Workshop continues to underperform, then it's understandable. And that may look like my own mistake for the next year too. It could continue to underperform for the next 10 years, and it may look like a mistake. I don't believe it was one, but however, I will fully hold it to myself if it was. I just believe that over the longer term that Games Workshop will come out on top compared to the likes of Halma. And I'd just like to note that it wasn't blindly selling over fears of the stock perhaps dropping further. It was instead actually a well thought out move, at least in my opinion, although I continue to welcome all of your criticism on my decisions, as it is very important for me to see counter arguments to what I may do in the markets, and it's always much appreciated. I just feel that there's a lot more potential in the likes of Games Workshop to fuel the growth in the short to medium term, but also the longer term with their intellectual property. If you're interested in the UK stock to buy in April 2021, then click the card at the top right of the video. Thank you for watching, have an afternoon, fantastic.